The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Tuesday the 16th, 30 minutes to the close. What do you need to know out of Europe this hour? Let me tell you, COVID continues to surge across the continent. Germany looks set to follow Austria, enforcing a lockdown for the unvaccinated. In Spain, regional leaders look set to tighten restrictions as cases climb. Ireland is preparing to return to home to work. Feels like we've been here before, doesn't it? The UK posting strong data as the end of the furlough scheme passes. The jobs numbers looking really solid today. Seems to have gone off without a hitch, without a major problem. The ONS numbers today reinforcing the idea that the Bank of England will hike rates in December. And as we've been talking about, European gas prices surging once again. We're at a 3-week high. This is Germany suspends certification of the Nord Stream 2 pipeline from Russia. EU carbon prices have hit a fresh record high today. Let's talk about the markets. Where are we with equities? This is the Stock 600. This is what gas prices are doing. I'm going to start with the Stock 600, 489. We did get through 490 a little bit earlier on. There are widespread expectations that we continue to push on from here. The valuation mismatch between Europe and the United States as wide as it has ever been. In fact, wider. Gas prices, there you go. That's the number here in Europe. We're looking at a 15% surge in European gas prices, Alex, once again. This feels like a familiar theme.
Yeah, that's definitely a deja vu for us here on this show, 100%. Here in the U.S., I actually wanted to highlight some individual movers because they're really also moving the index. So Home Depot up by about 5%. Super solid, super clean quarter. Second best performing stock within the S&P, pushing consumer discretionary higher within the index. Flip it, Walmart down 2%, super solid, but it was a squishy margins, as an analyst at Morgan Stanley pointed out, and that's kind of dragging on the stock. So those are the two retail highlights of the day, but overall retail sales came in very strong in October, very much surprising investors, and that sort of helping support equities just a touch. Now, idiosyncratically, Tesla up 3%. I don't know why, because Elon Musk is selling more shares. So that's something to always keep track of as we go. But maybe the stock has kind of shaken out all of Elon Musk's selling. And Rivian is worth more than Volkswagen. I'm just going to leave that right there. Rivian is worth more than Volkswagen, something I never thought that I'd say on television.
Yeah, I've got nothing smart to say about that because it absolutely blows my mind that is kind of where we are. So quickly after the IPO, so quickly after this company was created. Volkswagen's been around for a while. It knows how to build cars. It builds a lot of cars. It builds a lot of vehicles with various names. Absolutely amazing to see that happen. A lot of analysts over here are banging their hands on the desk talking about the valuation of European equities, which trade at a significant discount right now. We'll talk about that in just a moment. And by the way, don't think you've got a carte blanche to use that kind of squishy technical language on a regular basis.
Oh, it's happening.
Just because
an analyst
today,
says squishy, I'm totally adopting it.
You're good to go.
All the time.
Yeah. I appreciate we're getting into the technical weeds here. So let's talk about what is happening with the gas story and focus on that a little bit more, and also the COVID story, because that's really what's dominating the agenda over here. Let's start with COVID. Europe really grappling with a resurgence of COVID-19 cases. It's really sort of started in the UK, and the Prime Minister Boris Johnson talking about this yesterday, basically telling the British population, we're not done with this yet.
We must remain vigilant, because there is one lesson we can draw from the current situation in Europe. Those countries with lower vaccination rates have tended to see bigger surges in infection and in turn been forced to respond with harsher measures.
The Prime Minister would not rule out further restrictions. He would not rule out the fact that we could be heading towards a lockdown here in the UK. Other countries around Europe are already starting to move in that direction. For the details, we're joined now here on set by Eric Fanner. Eric, where are we in this process? We seem to be accelerating quite quickly into winter. A lot of restrictions starting to be imposed in various parts of Europe.
Yeah, that's right. It is really surging across the continent. I mean, it's interesting that the Prime Minister flagged that continental European surge, given the UK, of course, has been at this pretty high plateau for,
He implied we were behind them, not in front of them.
Indeed, that was kind of the implication, and actually the case numbers here are still quite high and stubbornly high. And so, we're heading into this time of year when people are indoors more, and normally, this time last year was when it just started to take off. Of course, in the UK, it's been pretty high for quite long. We're seeing that happening across the continent. It is alarming, obviously.
Hey, Eric, is this going to be a repeat of last year, or the therapeutics, the fact that there are vaccinations that people can get, does that change the trajectory here of cases and hospitalizations?
Yeah, I think there are two key things that you just flagged, that do change the equation quite a bit. I mean, the vaccinations, even though, it's kind of topped out in a lot of places at 2/3 of the population, that's still, really helpful. You get a lot of the most vulnerable people getting boosters now. Those programs are being accelerated. That makes a big difference in terms of the hospitalizations and the death tolls. Certainly has in the UK. We're seeing it elsewhere. Even though, programs are getting stretched, it's better than it was. And then there's the pills on the horizon, the Merck pill, the Pfizer pill. They've shown, really good results. So, the quicker we can get that rolled out, obviously that helps as the winter comes along.
All right, Eric, great analysis. Bloomberg's Eric Fanner joining us there. And Guy, maybe that goes away into explaining those record high European equity stocks.
Well, it partly goes towards that, yeah. Maybe there is a little bit more optimism. Maybe there is an expectation. We are hitting fresh record highs here in Europe. The market is up very strongly this year. This is a 30-year chart. I wanted to take it back a little bit longer just to give a little bit of context as to where we've come from and where ultimately, potentially, we could be going. Because we are hitting fresh record highs. We had a touch of 490 a little bit earlier on. We've never been here before. But we've also never been trading here in Europe. And I keep coming back to these charts because I think they're so fantastic. We have never been at a bigger discount here in Europe versus US stocks. It is a 30% discount that we're now at. Now, the discount has been widening really kind of since 2015. You can see the kind of the channel on this chart here. We obviously pushed sharply down during the pandemic as Europe got hit as hard as it did, but we have continued. European stocks have never been this cheap, Alex, versus the United States. Ever. It's just never happened before. And a lot of analysts, a lot of strategists are really starting to pick up on this. The question is, are investors going to start moving money in a significant way as a result? Yeah,
just look at Rivian and Volkswagen. I feel like that's a perfect example of what you're pointing out. All right, let's get more detail on this. Valentin van Nieuwenhuizen, NN Investment Partners CIO, joins us now. So, Valentin, do we see that discount close, and by how much?
Well, for now, we're not seeing it closed at all, obviously. But I do think it's clearly an opportunity. It's one of the regions within equities that we like the most because of this discount. Also, a little bit because of the sort of visibility that we have on policy in Europe. Although Europe is lagging the US from an economics perspective, there's very much visibility on a very easy policy stance, which is one of the things, next to the underlying fundamentals, both corporates and in sort of the macroeconomic dynamics, that keep supporting these very high levels in equity markets despite the COVID dynamics.
So what do you think we do next year? Does this just carry on? Valentin, very nice to see you. I haven't seen you for a long time. Does this just carry on next year? Do equities just continue to grind higher?
Well, indeed, very nice to be here, Guy. And I do think that into next year, equities are the place to be. Currently, we are seeing really record highs. We're also seeing all kinds of metrics that express investor optimism really on the high side. So for the short term, towards year end, maybe the first part of next year, there will probably be a bit of a correction and a bit more volatility. But underneath, as I said, the economic fundamentals are solid. Just look at the latest earnings reports, whether it's in Europe or in the US. For the third quarter, pretty solid. Corporates are able to digest these rising input costs very well. So all in all, I do think that with the economy going where it is, next year will be a year for equities as well. A bit of volatility to come, but it's my favorite asset class for 2022.
Okay, but I feel like I've heard this whole discount valuation equity story for Europe for a very long time. The dangerous question, why is this different?
Well, you're right. I do not expect that discount to disappear. It's just at record highs now, and I do expect the gap to be narrowing. But there is another aspect next to sort of the European-US economics and the gap there, or the COVID situation. And it's just a composition of the equity market. You gave the perfect example about the car industry. The sort of technology advantage that the US market has The disruption that's going on in our economic system is accelerated by COVID, but it's not started by COVID alone. And I think that advantage for the US market will continue to be there. So I do expect the discount to remain, but also to get it to make it smaller into next year. So it is a tactical opportunity to be long Europe compared to the US for next year. But I don't see over the coming years that the gap will be closed completely.
You're over there talking to investors. You're over there talking about what is happening with Europe going into next year. Yeah. As you're doing that, I'm watching the euro go lower and lower. We had a 113 handle today. We've got a 113 handle today on euro dollar. If I compare the currency hedged story in European equities, I'm just going to pick on the DAX here. The DAX year to date in euros has done 18% to the upside. That's comparable with the United States. The CAC 40's done 28%. But let's just stick with the DAX. The DAX has done 18% in euros. It's only done 10% in dollars. Yeah. How big a turnoff is that going to be for US investors?
Well, I think that is going to be a disadvantage also into next year, and that really comes down to what is happening to monetary policy. The ECB, for a change, is much more dovish than the Fed at this point in time. It is fighting hard against the market's expectations of already seeing hikes in 23, and clearly there's a strong commitment to keep policy very easy and to keep QE, although it will be calibrated, to keep QE in place. That's a very different planet than where the US sits, and whoever's going to lead the Fed going forward is going to be looking at reversing QE pretty rapidly and contemplating when to start with hikes. So I think that's the core driver, and that's going to be a disadvantage for US investors looking into the European market, despite the fact that there is a valuation support there.
So you mentioned that this is a tactical play, but that you don't expect that valuation gap to close 100%. So how long does this tactical play last for, and then what do you do on the back end?
Yeah, so I think it's going to be, at least until the overall economic setup or understanding of how all these temporary factors related to COVID have normalized. Also, the inflation picture has normalized. That will take at least another 6 to 12 months. So I think over that horizon, there really is an opportunity for Europe to outperform. In the medium term, you think about next 3 to 5 years out, I continue to expect the US market to be superior to the European market.
If you want to talk about valuation discounts, we probably should really talk about the UK. What is the outlook for the UK market?
Well, the outlook for the UK market, despite the fundamentals, is just so much surrounded by uncertainty, whether it's an intensification again on trade and Brexit, whether it is the sort of erratic behavior both on fiscal policy, but certainly on monetary policy. That's just inserting an enormous amount of, let's say, an uncertainty premia into UK asset prices. So I think it's a market where there might be really short-term opportunities, but not really a market that we like to play very actively. If we talk about tactical opportunities, it is with a horizon of 6 to 9 months and not with a horizon with, let's say, 6 to 9 days. And that's more sort of the horizon that you see your UK opportunities, I think. All
right. Valentin, thanks a lot. We appreciate it. It's great to see you here. Thank you very much for joining us. Valentin van Nieuwenhuizen joining us from NN Investments. All right, we have some breaking news for you. Janet Yellen is speaking in an interview with NPR. She's saying that inflation might subside by the second half of 2022. She's really pounding the drum on that guy. She has not strayed from that talking point. Yes, prices are high, but inflation will subside by the second half of 2022.
Well, that does in fact fit with what we're going to talk about next, because the IEA is talking about the fact that they see the end of this oil rally. That will certainly become welcome news if it were to pass for the president. Gas prices are super high at the moment. The IEA thinks it's going to come down. We'll talk about that story with Amrita Sen, Energy Aspects Chief Oil Analyst. We'll get a conversation in the mix there about what is happening with gas prices, natural gas prices here in Europe as well. I want to flag as well the Bloomberg New Economy Forum. It's going to be happening throughout this week. We have got some fantastic interviews coming up. We've got the CEOs of DBS Group, we've got PayPal, we've got Alphabet, you've got Goldman Sachs. There are so many. Actually, I can't list them here. It's going to be an incredible, incredible week right here on Bloomberg. Look forward to some of these interviews. We're going to make sure that you see them. This is Bloomberg.
More breaking news from Treasury Secretary Janet Yellen speaking at NPR. She's now talking about the debt limit. She says that she will issue new debt limit guidance shortly, and again reiterates that the U.S. Has a downgrade risk if there's no debt limit hike. But she can't imagine, quote, that Congress would let default happen. This is as we kind of tick towards the holidays, Guy, where you have a budget resolution deadline and you have a debt ceiling limit deadline again, which we already had 2 months ago.
I actually laughed out loud when I read that. Janet Yellen, quote, can't imagine that Congress would let a default happen.
That feels like a pretty non-passive aggressive point.
Yeah, I think plenty of people probably could imagine Congress making a mess of this, but we'll see what happens. It's going so well and so smoothly right now. Talking of things that are going so well and so smoothly, natural gas prices in Europe once again soaring. Germany confirming that it has suspended the process of certifying Nord Stream 2. I read this morning when I first came in, and I thought this was Germany playing politics. I think it's probably a little bit more technical in terms of the nature of what is happening here. Isis Almeida, Bloomberg's head of gas and power coverage in Europe, joining me now on set. Just explain to me what is happening here, because this involves a lot of different divisions of different companies making sure that they get the regulatory process lined up.
That's right. I think one of the rules of the European Union is that you cannot own the gas pipeline and produce the gas and own the gas as well. So you've got to do one of the two. And right now, Gazprom owns the pipeline. Nord Stream 2 AG, which is the Swiss entity, is fully owned by Gazprom. So it's unlikely that they will get approval to actually start flowing gas with this corporate structure in place. So one of the things that they've done is a German regulator now decided that it cannot proceed in the way it is, and for gas to start actually flowing, the approvals to come through, they basically have to set up a legal entity in Germany, and that's why the process has been halted.
So, Isis, in a weird way, could this be a good thing in that once this subsidiary is set up, things could actually move more quickly?
Well, I agree. I think it could be a good thing. Depends on whose eyes you talk about, but if you want more gas into Europe, this could actually speed up things in the end. But there is actually a delay right now because the process was about 2 months from finishing, and right now there's a pause on the process, and we're going to have this pause all the way until the documents are submitted and the German regulator can start looking into the case again, and then the 2-month clock starts ticking again. So initially there is a delay, but if everything gets set up the way the German regulator wants and expect, it may actually in the end result in gas flowing out of Nord Stream 2.
All right, we'll wait, and we're waiting. All right, Isis, thanks very much. Bloomberg's Isis Almeida, thank you so much for joining us. So that's the natural gas picture. In the meantime, oil executives over at ADIPEC are defending fossil fuels.
The energy industry is in very huge transition, very exciting times, obviously. Everybody's making an adjustment to make sure that we meet the net carbon zero target of 2050. For some countries can't make it at 2050, but obviously the whole energy industry is adjusting, is changing.
For the foreseeable future, traditional fuels, petrol and diesel, petroleum are going to be the mainstay of the global economy. And I think we need to factor in very carefully what happens when those prices go through the roof.
There is, of course, some hype in the market, but at the same time, looking forward, we have the seasonal drop in demand in winter. We have more and more oil coming from the OPEC Plus group, 400,000 barrels a month. Every month is being added. And coupled with a seasonal trough in demand and some more lockdowns which you're experiencing, we believe that there is no deficit at the moment. There will be surplus.
We are not going to continue having this problem that we are seeing today moving to the first quarter of next year. And that is the comforting news.
Okay, some of the comments coming out of ADIPEC in Abu Dhabi, the huge energy meeting that's taking place there. Let's talk about what the IEA sees happening. It is talking about the fact that we may be near a peak, that oil prices potentially could drop in the not too distant future. Amrita Sen, Energy Aspects Director of Research, joining us now to talk about this. What did you make of the IEA's outlook? Any credibility here? Do you think finally we may start to see energy starting to fade in terms of the cost we all pay?
Well, I think there was some contradictory stuff in the IEA report, wasn't it? Because it talks about how, there is the tide is turning and how prices are going to come off. And I don't know if you noticed, they've even issued some price forecasts, which they rarely do. Very much an effort to kind of pin or point towards the US and say, look, we don't need to do a coordinated SPR release. The balances are going to be fine. Yet they revised their oil demand forecast higher, right? So there are some kind of inconsistencies there. Their balances, I mean, especially if you look at what they are predicting, they have a lot of unaccounted for barrels. And once you do put that in, we are still seeing very big stock draws, even in Q4 of this year. Next year, yes, their balances are bearish. They are so bearish that they're saying OPEC Plus shouldn't even increase production beyond current levels.
Do your models say the same, Amrita? Because many talk about the fact that other members of OPEC Plus are not able to pump what they're supposed to, and there is some confusion as to how much shale players are willing to pump.
Absolutely. And I think, well, there are three factors, I would say. One is demand. If we've seen anything this year, people are driving, people are flying, regardless of price, by the way. We are seeing huge amounts of pent-up demand. So I think that we are going to continue to see next year as well. Asia is just starting to reopen. China, by the way, given kind of continued COVID lockdowns, we're still not even seeing that kind of improvement or improvement in kind of jet demand there. So there's going to be more pent-up demand. Second thing, exactly like you said, shale, still not growing production, returning value to shareholders. And third, OPEC Plus members, plenty of them. I mean, look at the amount OPEC Plus is increasing. They're not even able to hit the 400,000 barrels per day due to underinvestment, be it Nigeria, Angola, lots of countries.
Amrita, very quickly, 30 seconds. Can oil prices come down if gas prices stay high here in Europe and around the world?
The only way it's going to come down is if you get an SPR release. Everybody's expecting that from the US. It's going to be momentarily coming down. We've priced in most of it. And then ultimately, stocks are so low. We are really at like 10-year lows, if not lower. We are going to be going up again in a matter of weeks. It's just seeing this period through with all this uncertainty around the SPR.
It's going to be a really difficult winter, isn't it? We'll see exactly what happens here. Amrita, thank you very much indeed. I'm sure you'll be back to talk us through what we should expect. Amrita Sen of Energy Aspects. European stocks broadly positive as you head into the close. That's coming up very shortly. We also need to talk about UniCredit centralizing in Milan. If you're going to centralize anywhere, Milan, well, there are worse places to centralize. That's coming up next. This is Bloomberg. 4 minutes to the European close. European stocks generally on the front foot. The FTSE 100 is a little bit of a laggard. The drug sector in particular, the drag there. But generally, we are more positive. The banks are down a little bit. UniCredit's a name I want to focus on. It is going to centralize in Milan. Orcel's starting to make an impact at that institution. We'll talk more about this. This is Bloomberg. So we're wrapping up the Tuesday session here in Europe. A bit more of a mixed session, certainly for European equities today. The broad narrative, though, is that European equities are cheap. They're trading at a huge discount to the United States. Today, we focused a little bit more on what is happening in some of the defensive sectors. So the London market in particular being dragged down today by the healthcare stocks. Think AstraZeneca, huge weighting within the FTSE 100, a little bit of softness there. The banks generally have been a little bit weaker as well. The CAC 40's only up by 0.4%. Names like BNP Paribas acting as a little bit of a drag. The DAX, though, up by 0.6%. Let's show you how the session has developed, how we kind of progressed throughout the day. What we got initially, you can't see this because this is over here and this is yesterday. We got a big gap higher first thing. That took us up to around the 490 level. We got through this. We then dipped a bit. We had another try up there. We got a kind of double top in terms of the 490 hits that we've been taking. We've faded a little bit since then, but we're at or close once again. We're kind of inching ever higher for European equities to those record highs, and we continue to make them. So we're kind of just below the 490 level, but a lot of people have got targets for next year that certainly have a 5 at the beginning. Let's talk about the breakdown from the sector point of view, just to give you an idea of the kind of the rotation that we've been seeing in the market today. Retail, really solid day, unsurprising given some of the numbers we've seen out of the United States, and the quite good labour data we saw out of the UK today, plus some individual names in terms of the reporting that we've seen. Energy's up, real estate's up. those are the three best performing sectors. Bottom end, it's a bit more defensive. Some of the consumer stocks are down. Construction's a little lighter. Media, a little bit lighter as well. But there's some individual names that I think are really worth focusing on. So let's spend a little bit of time talking about that. Thyssenkrupp's interesting. Vodafone's interesting. Restaurant Group. Restaurant Group, I'm going to start actually over here and we'll finish back there talking about what is happening with Thyssen. The Restaurant Group owns Wagamama. Which is, you find it in a lot of the high streets, you find it at a lot of airports. Really good numbers, really good outlook in terms of what we're seeing here. Certainly defying expectations and certainly beating expectations for the rest of the sector. So maybe there is a sign that actually what is happening here in the UK is that we are starting to progress maybe from a sort of a buying of stuff to buying of services. And that certainly would speak to the Restaurant Group's numbers, as I say. So the stock up by 16.9%. Vodafone, solid set of numbers as well. The stock up by over 5%. Really good look ahead in terms of what is happening here. They've narrowed the full year guidance. Really positive outlook there. The dividend outlook looks pretty good. Services revenue, again, looking really solid. So Vodafone up by 5%. That's a real heavyweight in the FTSE 100. I want to wrap things up talking about Thyssenkrupp. Now, this is a financially stressed company. Stretched probably is the better way of putting it. There was news today, Alex, that it's going to be looking to hive off its hydrogen unit. Now, this is interesting, obviously, in the light of what we've just seen with COP. This is a unit that uses renewable energy to then drive the reaction required to produce green hydrogen. Now, a lot of people are talking about this being the way forward. Obviously, this is sort of an industry that's in its infancy. But Thyssen, given their financial position, has decided that they should take advantage of the interest and maybe look to crystallize some of that value. So Thyssen today up on the back of that by 12%. Huge move on that story.
Yeah, let's get more on that. It is quite interesting that they did it now. Bloomberg's William Wilkes, who covers Thyssenkrupp, joins us. Why did they do this now? As Guy pointed out, green hydrogen is in its infancy versus, say, gray hydrogen, which is like just full on making hydrogen using straight up oil.
I think, as Guy alluded to, it's because, you know, this Thyssenkrupp is trying to restructure. It's in the steel business, which is doing a bit better than it in recent months than before, but it's still kind of a low margin business that struggles to cover its cost of capital over a cycle. So I think listing this would give Thyssenkrupp the funds to expand and scale up the business, where you're right, it's behind other forms of hydrogen production, but it's starting to get bigger, and you've got a lot of big German industrial companies really looking for solutions that would give them green hydrogen to use in industrial heating processes like chemical manufacturing or steel.
Do we know whether or not Thyssen are going to try and retain a stake in the business? What is going to be the future relationship between the kind of the old company and the new company?
That's not clear yet, Guy. I imagine that Thyssen will probably want to retain some of the company to kind of be able to profit and to take advantage of probably what will be rising profits and demands and demand for this sector. But I don't think a final decision has been taken on how much they would hold on to. They also do still, you know, it's not just about benefiting from this asset that probably has a good future. They also still kind of need cash there to continue to fund the restructuring of the company. Mm-hmm. I mean, Thyssenkrupp, at the start of the pandemic, people thought, you know, that's it for Thyssenkrupp, and they've done remarkably well to get through the pandemic. So,
in the piece, you wrote that an IPO could value the business at about $5.7 billion or 5 billion euros. How do we get to that? How do we value a company that's in its infancy like that? How do you value the spinoff?
The bankers working on the deal have come up with that valuation. I think it's based on the outlook for hydrogen, a bit on current earnings, which are about 250 million euros a year. And I think it's the expectation that demand is going to rise and that those revenue numbers will just keep going up.
Are there any more hidden gems at Thyssenkrupp?
Unfortunately, it seems like not. They're trying to sell other businesses, and they're not getting so far. The big thing they need to do is sell their steel division, but it's kind of the opposite story of the hydrogen thing. The steel manufacturing in Europe have a future. You know, the steel industry is very polluting, as we've seen from COP26, that there's going to be more and more increases in the cost of emitting carbon dioxide emissions. So I think actually Thyssenkrupp's looking at its portfolio, and this is one of the few remaining gems that they have, apart from a couple of businesses that they've said they're going to hold on to.
We'll leave it there. Great piece, fascinating story. William, thank you very much indeed. Bloomberg's William Wilkes joining us on Thyssen. Getting out of the hydrogen business, you could argue, but amazing to see how you ultimately, as Alex says, value a business like that, considering how in its infancy this industry really is. OK, let's move on. Let's figure out exactly what the final numbers look like here in Europe. We've now settled. We're through the auction. These are the final figures. As you can see, we'll get the camera out of the way. FTSE 100 down by 0.3%. And we did see a little bit of a dip, Alex, a little bit of a spike lower during the auction, taking us down towards session lows. It was the big drug makers in particular that the London market lagged a little bit. Banks a little bit over on the CAC Iran, but actually the DAX outperforming today, up by 0.6%.
Just fun fact, real quick, Guy. Thyssenkrupp, when I went over to London as a reporter like 10 years ago, I did a hit with you on that. I did a report on Thyssenkrupp.
I remember it well.
You don't.
It was a fantastic hit.
You do not. Now
amazing.
You're just mocking me.
Of course, that's what I do.
And I remember being like, wait, how do I say this name? Which actually should come as no surprise to anyone. How far we've come. How far we've come. All right, let's get to the breaking news. Janet Yellen talking to NPR about the debt ceiling. Here's what she's saying. She's saying that the debt limit process is a self-inflicted wound. Not a great deal of time left for the debt past December 3rd, which feels like she's putting a little bit of a drop-dead date then, December 3rd. And that the new guidance will be forthcoming on the actual timing of the debt limit. We are seeing a reaction, though, in the T-bill market. So some of the bills that are actually maturing at the end of December, their yields are moving a little bit higher. So clearly this is still something to pay attention to, particularly for the bond market. We'll update you on any headlines as they cross. All right, coming up, the UK labour market is strengthening in October. Super solid numbers. What does the BOE do? Melanie Baker, Royal London Asset Management senior economist, will join us next. Is it December? Is that the hike? We'll discuss. This is Bloomberg.
This is Bloomberg Markets, the European close. I'm Ritika Gupta, and you're looking at a live shot of the principal room. Coming up, the former U.S. Energy Secretary Dan Brouillette at 12:30 p.m. New York time. This is Bloomberg.
Today's jobs figures are the first we've had since furlough ended, and what they show is that unemployment has consistently and continuously fallen for 9 months in a row now, and record numbers of people are in work, including, I can announce today, 100,000 young people who have started jobs through our Kickstart scheme. So that's all testament to our plan for jobs working.
4.5 to 4.3, the UK unemployment rate. That was, of course, Rishi Sunak, the UK Chancellor of the Exchequer, talking about the labour market data we've seen today. Quite a significant recovery. I think what is critical here is that we have seen a relatively smooth transition out of the furlough scheme. That was what everybody was worried about, that you would see the furlough scheme causing huge problems within the labour market, a lot of people ending up unemployed as a result of the ending of it. Melanie Baker, Royal London Asset Management senior economist, joining us now. Melanie, I think a lot of people are surprised, impressed that we've managed to negotiate the end of furlough quite so smoothly. We're going to get another piece of labour market data before the Bank of England meets next. Do you think we need more evidence to confirm what we saw today?
Yeah, no, I think we do. So we have a good picture, as you say, so far, but we have a partial picture. So they will have, as you point out, another set of full set of labour market data before they next meet in December. So far, for example, we only have the unemployment rate for the 3 months into the furlough scheme, and as you said, that was lower than expected. That's a good number, but it could still rise. We know there were over 1 million people on the furlough scheme when it ended, and we had survey data, for example, from the Resolution Foundation over the weekend, suggesting that about 3.5% of people who were on furlough at the end of the scheme were unemployed in October. But you were talking, it's still about relatively modest increases in the unemployment rate.
Melanie, I'm looking at the gilt market. 2-year yield is up by 3 basis points. gilt traders were super burned last time when it felt like Andrew Bailey was talking up a rate hike and then didn't deliver. Does this pull any triggers here?
Not yet, I think. So I think one thing that I would have been more concerned about in that sense would have been the pay numbers. So the pay numbers today, if you look at the regular pay growth figures, were actually a touch weaker than expected. Month on month, there was no increase in the level of pay either. So a little, I guess, less worrying from the pay numbers today. But yeah, I think that everything on the whole looks in line with them raising rates as they've signalled in coming months. For me, that means February, but I do think that there is a good chance that it's December.
Why do you think February rather than December?
I think this is a big decision. I think they'll want to communicate well. When they have the February meeting, they'll have the press conference. They'll have a full set of economic forecasts to talk about. Exactly. So I think on the whole, for me, it's February, and we'll have just a bit more data to go on.
So if they start in February, how far do they go?
Yeah, that's a good question. I mean, look, for me, I think we'll see a gradual process of rate increases from here. If you look at the general message of their last inflation report, it really was that they're not in a panic or a hurry at this point. So, for me, it's probably another one later in the year, in the second half of the year, probably November, and then, roughly, a 25 basis point increase a year thereafter. So it's sort of a relatively slow and gradual progression in interest rates.
Given the trajectory we're on with COVID at the moment, not only here but elsewhere across Europe, do you think, does that speak as well to the idea that maybe February would be a better idea? Would it be smarter just to wait and get through the winter and see what happens? Picking what's going to happen with COVID seems like a really difficult job right now.
Yeah, I don't want that job yet. But, I mean, there's something that health experts have obviously warned about, that we could get this combination of flu and COVID, and that could lead to a difficult winter. So, yeah, and you can see what's happening in Europe. It's not just the sort of the COVID figures, but governments are responding to those, and we are seeing more social distancing restrictions put in, which can hold back the recovery in Europe somewhat. But in the UK, it doesn't sound as if we're building to any significant increase in social distancing restrictions here.
But it does seem, Melanie, that further lockdowns in the UK have not been ruled out. And I wonder how you think the economy would handle something like that now that the furlough program, for example, it is over. Does the government kind of come to the rescue again? How do you think about it?
Yeah, I mean, look, if I think if you look at the last lockdown we had at the turn of the year, you could argue that the economy seemed to cope much better with that than it did certainly with the sort of first set of lockdowns. So the damage to the economy was much less. But I think there's a good chance we'd see the furlough scheme returning on a temporary basis if we had another lockdown.
I'm assuming that the governor is going to have to write a nice letter to the chancellor talking about why inflation is above target. We're going to get the CPI numbers tomorrow. How much above target do you think we are right now?
Quite a lot. So my forecast for the data tomorrow is that it jumps. The CPI number jumps from 3.1 to 4%. So quite a lot above target. But if you look at the drivers of inflation, it's going to be a lot of it's going to be energy prices, right? So we've got the jump in the Ofgem price cap, higher petrol, diesel prices, and maybe a bit of upward effect as well from the phasing out of the VAT cut we had on hospitality. So a lot of things I think that can be relatively safely put in the kind of transitory bucket from a central bank perspective.
Yeah, that's going to be pretty interesting there. All right, Melanie, thanks a lot. Melanie Baker, Royal London Asset Management Senior Economist. Thank you very much. But, Guy, I do think it's interesting on what the tolerance is going to wind up being. But look here in the U.S. Inflation super high, CPI surprise to the upside, sentiment tanking, sales holding up, retail sales doing just fine.
Yeah, all those things are obviously connected, but you do wonder whether consumers are front-running at the moment, not only for the holiday season, making sure that you've got enough presents to put under the Christmas tree, but also the fact that if prices are going up, people maybe want to get out in front of those. So maybe we are starting to see consumer behaviour being affected. Certainly there's an expectation that there is definite bring-forward purchasing happening here in the UK as well. People are worried about the fact that there's going to be shortages, not only because of what is happening with global supply chains, then you've got the Brexit factor as well, which is just making things even more tricky.
Which is why you bought your bike,
Yep.
August, was
Not
it?
my bike, my son's
July?
bike.
Son's bike.
Well, not quite. No, it wasn't quite that bad. But yeah, trying to buy a push bike in the UK at the moment is a tricky job. Believe you me, there are shortages, a huge high-end.
Don't get him started.
Sort
I just
of
got him
manufactured
started.
products.
And wood
Yeah, okay.
and fancy wood from somewhere.
Precisely.
All right, guys, bummer.
Large.
All right, coming up, we're back at that point again. We're gonna have to break down the debt limit risks here. Treasury Secretary Janet Yellen calls the whole process a self-inflicted wound. We'll break it down next. This is Bloomberg. Yields on Treasury bills maturing at the end of the year rose after Treasury Secretary Janet Yellen said they don't have, quote, a lot of time left for borrowing past December 3rd. Now, she says she'll be updating Congress the next day or two on how much time is left before the government runs out of cash. That drop-dead deadline is what we talk about. Bloomberg Washington correspondent Emery Hordern joins us now. Emery, Janet Yellen speaking at NPR. Walk us through what else we learned here. She's clearly trying to put some serious pressure on Congress.
Yeah, it doesn't look like it's going to be a Merry Christmas going into the end of the year, does it, for Congress? We're exactly where we were just a month ago when we were able to lift the debt ceiling, at least Congress was, and avoid coming up to the edge of that cliff. Now, Treasury Secretary Yellen is going to have to let Congress know again what is that X date. Potentially, Treasury will be able to go on through December 30th, December 3rd, excuse me, maybe into January. Yep. She'll give us a little bit of range time of that date. But there's a lot of pressure now on Congress. They're trying to get through a massive social spending and tax plan on top of the debt ceiling. A stopgap funding measure will need to be done as well as a defense act. So time is really ticking, and they only have about 2 weeks of working days left.
She says she can't believe that Congress would make a mess of this, but presumably the Dems are on their own here.
Well, Mitch McConnell, the minority senator from Kentucky, he was able to mitigate away from the Democrats to do it a pretty easy way in Congress. And now he is saying that the Republicans will not sign up for it. For the Republicans, it is, even though it is past debts, for them, it is a moment of protest because they are very much so against the larger fiscal package that the Democrats want to push through, and they were not going to make it easy. So we're back to square one where the Democratic Party is going to have to potentially put this in their reconciliation package.
So Mitch McConnell came to the rescue the last time and gave this extension in terms of the debt ceiling. Does that happen again?
According to him, it does not. According to him, he will not do it again. He was able to help mitigate it last time. And for him, I've given you enough time for this party that holds the House and the Senate, I'm paraphrasing here, for you to decide how you're going to include the debt ceiling as part of your nearly $2 trillion reconciliation package. That's the stance from Senator McConnell, and it's likely going to be the stance from all the Republicans behind him.
Let's talk about what is happening at the White House with regard to the Fed. Sherrod Brown, the Senate Banking Committee chair, making a fascinating statement. I hear it's imminent, he says. I'm not going to speculate who. I think it might be now. I assume the decision has been made, but they haven't announced it, but I don't even know that. What do we know?
That's a great question. We do know that it's likely going to come before Thanksgiving, but when I hear the word imminent, I think hours, not days. So potentially Senator Brown there wasn't so much helping us with the timeline. What we do know is that the president did meet with Chair Powell and he did meet with Governor Brainard. These are likely going to be, these are the two top contenders really for that top spot. But we're still waiting on details. Is the president going to do just the top spot, or is he going to talk about all the other nominations that the Fed has open right now and a reimagination of the Fed? This also potentially is another to-do list for Congress as well, to get through a next Fed chair on the Senate side.
AMH in DC, thank you very much indeed. Imminence, we'll see what that means. It's a bit like transitory, really. Nobody's quite figured it out yet, but it'd be nice to know. Anyway, Amory will be the first to tell us, I'm sure. Okay, let's talk about what else is coming up in the next 24 hours. It may be that we get a Fed decision. We will wait and see. Maybe we will get it. Maybe it will be imminent. Bloomberg's New Economy Forum, certainly going to be talking about this. It's going to be happening in Singapore. We have got some great guests lined up from there. Fed Presidents Mary Daly, Thomas Barkin, Esther George, Raphael Bostic, all speaking today as well, Alex.
That is going to be quite a busy 12 hours. Then tomorrow we get more stuff. U.S. retail earnings, you got Lowe's, Target, TJX, and chipmaker NVIDIA. We're also going to get U.S. October housing starts, plus UK and Eurozone CPI. Just how hot can it go? How hot is hot, and how transitory will be defined? That's going to be some pretty fun data points. They're upset for me and Guy on TV. Coming up, Libby Cantrell, PIMCO's head of public policy, will be joining Balance of Power with David Weston on Bloomberg Television and Radio. Guy and I also, we're headed to radio.
We certainly are. The cable is coming up. That's where we're going. This is Bloomberg.